So yesterday we started with goodwill. Okay. So you should understand what is goodwill. I also gave an example. A company wants to acquire B company. Okay. So the B company's net assets. Net assets is nothing but equity. And the fair value of that equity is nothing but, let's say, $100,000. Okay, so fair value of net assets, what a company is willing to acquire is 100,000, and a company is ready to pay, or the consideration what they are ready to pay is 120,000. So the 20,000 what is getting created here is a kind of a asset which is not of a tangible nature, which is an intangible nature asset. Why? Because extra money, why are you paying to that particular why are you paying the extra money to these shareholders of that company to acquire it? Maybe that company has a goodwill, reputation, and number of factors, right? So this 20,000 is nothing but goodwill. Now, so that's what they have given here as the formula. So what the acquirer is paying to acquire the investee, okay? What amount the investor is paying to acquire the investee is the cost for the investor. So value of a business as whole. So cost of the investment plus any non-controlling share not purchased. So we see what happens is, instead of just making the payment of the, see, sometimes it can be 100% acquisition. In that case, you don't worry about this particular non-controlling interest. What about it is just a 80% acquisition? It's a part acquisition, not full acquisition, right? In that case, you are not going to acquire the non-controlling interest share, right? So what we will see, to rule out any kind of complexity in the calculation, like instead of doing that, like you can do one thing now. You are acquiring 80%. So you can do one thing in that case. You can take the total net asset value, that is equity. You can find out the 80% of that, and what you are paying for that 80% is nothing but the goodwill you can ensure. Okay, and then NCI can be taken separately. What I mean to say here, you are just acquiring 80% of a company, right? So let's say the company's value is $100,000. Of that, you are only acquiring 80% shares, so it is 80,000. The rest of the amount is 20,000 is of the non-controlling interest. Okay. But what are you paying for this? You are paying 120,000, right? You are paying this 120,000. If I take up 120,000, as per these people, you have to add the NCI as well. It becomes 140. And then you have to subtract the fair value, that is 1 lakh. So 40,000 is the goodwill, right? But instead of that, what we were doing, we were just taking 80%, right? We were just taking what? 80%. So 80% of the entire 1 lakh is how much? 80,000, right? Come on, tell me yes or no.
Yes, sir.
Yeah. So 140 minus 1 lakh was 80, was 40, sorry. 140, 1 lakh 40,000 minus 1 lakh is 40. Instead of that, I'm just putting that NCA aside. Okay. And I just took the 80% of the stakes in this company. And I'm paying how much for that 80%? 120. Still I'm getting how much? 40, right? Yes or no? Come on.
Yes, sir.
But instead of that, what I say is go with the methodology what they have shown you. Okay. See, the amount what we are paying is of course 120, and we are only acquiring 80% of that company. It's a known fact, not 100%. So the goodwill is getting aroused here as well, but I would always tell you to follow the steps what ACCA tells to avoid any kind of complexity. So the format is clearly given here. Consideration transferred, what the parent is willing to pay for acquisition of subsidiary. Non-controlling interest, if any, if it's a part acquisition, non-controlling interest will be there. Add that value and subtract the fair value of net assets acquired represented by equity, or what they are saying, net acquisition date, fair value of identifiable assets acquired and liabilities assumed, that is nothing but asset minus liability, that is equity. Very clearly understood. Okay, if in a question, of course a balance sheet will be given, equity will be given, this two data will be given. If you subtract all the liabilities from asset, it will be a complicated case. Better to take equity directly. Equity should be considered in a broader sense. It is equity share capital, retained earnings, revaluation surplus, etc. Okay, since you are not exposed to the presentation of financial statements chapter, I am giving a clear idea. So equity here means share capital, that is equity share capital, retained earnings, share premium, revaluation reserve, okay, or surplus, whatever. So just make a note of this fast. We are going to solve and see, and we are going to find out the goodwill value fast.
Done, sir.
Now, subsequent measurement, once the goodwill has been calculated, every year impairment review should be done for that. What is impairment review? We have to say whether the goodwill value has gone up or the goodwill value has deteriorated or gone down. Accordingly, we should recognize the gain and the loss. Okay, so we will be doing that as well. First, let us find out the goodwill value here. Now, goodwill. As the things have been clearly mentioned to you, it's now your job to find out the goodwill value. I'll give you the time. Okay. And we will also do the consolidation here. Fine. Along with we will find out the goodwill value and also we will do the consolidation. Right. That makes sense now. So here is the question in front of you. Uh, at 31st December 2004, the statements of financial position of Porter's and Sanus company were as follows. This is the statement given to you. PP is given, investment in Sanus at cost is given, current assets are given, and you also see that there is equity capital given here of the subsidiary. We have to cancel it out. I have already explained you that, and the reserves are also given. And let us see whether it's a part acquisition or full acquisition. So let's see the data. Note on, yeah, it's a fully acquired company. So on 31st December 2004, so you can see all the balance sheet details here. State SOFP details here. On 31st December 2004, Potter's company purchased a 100% holding in Sanus company for $13.8 million in cash. They made the investment, right? Cancel the investment in Sanus company in Potter's books with the shares and reserves. At the date of acquisition, they said in Sanus company's books. Any difference is goodwill. Okay. So what we are going to do, we are going to see and we are going to calculate the goodwill. Fine. So once you see the question, and then you also develop an idea how to do that, we will go ahead. Okay, we will do the consolidation, and as well as we will also find out the goodwill. Okay, so let's do the consolidation simply. First and foremost step is you need to add this two. Tell me the total. Hello.
72,800.
72,000.
800.
So let's write that here in the box. Then we are going to find out the goodwill value. So already we know what is the consideration goodwill. So I'm just doing the calculation here. Goodwill calculation. What is the consideration transfer? They said 13.8 million, right?
Yes.
So consideration, yeah. Transferred, it is 13.8 million less net assets acquired represented by equity is what I say. So what are the net assets acquired by equity? Net assets acquired represented by equity. So the share capital of the like subsidiary is how much?
2,400.
Yeah, 2,400, right? So instead of that, you can also 2,400, and the retained earnings is also a part of equity. So it's 13,000, correct? Clear?
Yes.
So you can also do that. Now you can check that. You can add all the assets, 16,200, and the total of assets is how much? 18,600, right?
Yes.
18,600 minus
13.
just do this this one, 4,800 and 800. How much?
13,000.
That's what. So since you know that if I have taken total of assets and I have removed the total of liabilities, in the sense both the liabilities, I'm getting what? Equity. So directly if I take equity, I save my time, right? For all this exercise.
Yes, sir.
Yeah, so I take this equity here, 13,000, and my goodwill or my intangible asset which has got created is 800, right? Yes.
Yes, sir.
So just make a note of this. We'll put it there. And see, the statements are on this at 31st December 2004. The statements of financial position are this at the end of 2004. After calculating this, you tell me. We'll go forward first. Shall I move forward?
Yes, sir.
Yeah. So we will write goodwill here. See, I already told you when it is a consolidated company, this should be cancelled, right? Against the share capital.
Share
Is it
capital.
right? Yeah. So that is equity. So we have just removed and we have got 800, which we have shown as goodwill. Correct or wrong?
Yes, sir.
Yeah. And just a second. What did they ask? Cancel They have already told you cancel the investment. So one more point you should remember, it is not always done like that. Cancel the investment in Sanus company in the Potter's books. So in the parents books, whatever the investment you are showing, you have to cancel that with the shares and reserves. So they are very clear in that case. So we have cancelled, right? What did we cancel? We cancelled the share and reserves, correct or wrong?
Yes, sir.
So 13,000 we cancelled there, and 13,800 is what we have here. So whatever we cancelled is to the tune of 13,000 in both. It's a full acquisition. So extra paid is goodwill, right?
Yes, sir.
So that's what I'm saying. 13,800, 13,000 here in books of subsidiary. So 13,000 to the tune of 13,000 we are cancelling. 800 is extra. Leftover 800 is intangible asset, goodwill. So that is known. Now you do one thing: inventory, trade receivable, cash. You find out the total amounts and tell me. We will write there.
$4,100, sir, inventory.
4,100. Here 4,400, right? Here 1,800, right? Just take these three values: 4,100, 4,400, 1,800, and put it here. Right? So now you do the totaling of all the assets, because we are done with the assets part. Add up all of them and tell me what's the total.
$83,900.
Right? And you already know the rules. We shouldn't be taking the share capital of the subsidiary, right? We will be taking only the share capital of the parent, right? This doesn't make sense. So only the share capital, which is nothing but the equity of the parent, should be considered. Is it right? Clear?
Yes,
Now,
sir.
because it's a 100% acquisition, there's no NCI at all. So 62,100 will be taking there. So 50, what is the share capital? Like 8,000, 54,100. So it's like total 62,100. Is it right? Hello. Hello.
Yes, sir, yes.
Yeah. And you know that 10,000 has been acquired. So 10,600. So it won't be existing now. So I just remove, I'm not considering that. See what happens. There are two things here. Pre-acquisition reserves will be going for goodwill calculation. What matters is post-acquisition reserves. So post-acquisition reserves, what you have will be like, if it's a full acquisition, okay, if it's a full acquisition, then that will be kind of income for the parent. But it is a, if it's a part acquisition, then suppose 70%, suppose of that goes to parent and 30% goes to NCI, and you have to find out the NCI value as well. So that we are not doing right now, we'll be doing afterwards. So no need to worry. Okay. Then you should add all the non-current, the borrowings and all, and we will close this and go for the next one. Add up, add this two and tell me. 3,800.
18,000.
18,000 and 3,800. Okay. 18,000 reserves. What is the reserves here? So we have 18,000. How much is long-term borrowings? 18,000, right? And
Yes.
3,800. Just make the total of this.
Valid 83,900.
So this is done. Okay. Shall we move forward?
Yes, sir.
Now comes the non-controlling interest. Already explained to you. If 80% parent holds in subsidiary, okay, then 20% is held by NCI. Mid-year acquisitions. So mid-year acquisition is nothing but the acquisition has happened in between, not at the beginning or not at the end. So any profit or reserves, whatever it will be given to you on the date of acquisition will be considered pre-acquisition reserve. And beyond, like after the parent acquires the subsidiary, whatever the reserves get created, let's say sometimes they'll be giving you a lump sum amount of 20,000 at the end of the year. So in that 10,000 is the pre-acquisition reserve. So rest of the 10,000 is post-acquisition reserve, right? And this has to be apportioned between parent and NCI. Shall we go for a question? Yeah. So here the question is given. First Jan is the start of the year and end of the year, mid of the year. If the acquisition is done on this time of the year, it's called mid-year acquisition. Okay. This is called pre-acquisition period. This is called post-acquisition period. Okay. Shall we move forward? Yes. So this is a question here on 31st December 2004. The statements of financial position of Porters and Sanners were as follows. The same statements are given to you, but what additional points they have given? Let's see. On 1st April, that means Jan, Feb, March. That is 3 months is the pre-acquisition period, and rest of the 9 months is post-acquisition period, right? So on April 1st, the parent has purchased 80% in the subsidiary for this much million in cash. So they have paid this much to acquire the subsidiary. And Sanners company's total comprehensive income for the year was 2.0 million, accruing evenly over the year. So they have even given the total comprehensive income at the end of the year on December 31st, right? So with that, we can get an idea of pre-acquisition and post-acquisition reserve. Correct? Please tell me yes or no.
Yes.
Hello. Yeah. So we will deal with that. Need not worry. We will deal with that very clearly. I'll explain you how the things are moving here. And the NCI has a fair value of 3.2. So no need to worry. They have given the NCI fair value as well. So you need to make the consolidated statements. With this, I just want you to find out the goodwill value. So can you just find out the goodwill value right now? Goodwill value is not going to change, right? 13.8 million is the consideration transferred. Is it right or wrong? What is the consideration transferred?
120.
Sorry? 13.8, right? Non-control. So they are asking you to prepare the consolidated statement of financial position. So NCI is also given in this case. NCI is 3.2. NCI at fair value, but our format says we have to take at cost. What is the format? Non-controlling interest. So here we have to come to the non-controlling interest. Okay, parent does not own all of the subsidiary. Okay. Non-controlling interest of the equity is non. Okay, okay, fine. Okay. Remember, you do not have to own 100% of a company to control it. The group accounts will need to show the extent to which assets and liabilities are controlled by parent but owned by other parties. Okay. That also we understood. Acquisitions. Okay, okay. Media acquisition. Okay, okay, okay. Post acquisition reserves must be consolidated. Okay. Okay. Okay, fine. So the investment is 13,800 and the subsidiary companies, so they have given something here, right? They have told that on 1st April, Porter's company purchased 80% of an 80% holding in Sanus company for 13.8 million in cash. So we will be taking only the what we will be considering on the date of acquisition. What is the what is the reserves, right? So we will be taking net assets acquired represented by equity and we'll be considering the equity. So what is the equity? 2400. And what is the reserves? 10,600. Why I am taking 10,600? The balance sheet belongs to which date? Come on, tell me. It is which date balance sheet?
31st December.
31st December. And the acquisition happened when?
April.
April. So the balance sheet here, what we are seeing also has post and pre-acquisition reserves, right? Then how? So reserves. So reserves, we need to be careful here. So we need to now do some calculation part. Understood? Okay. They are giving some information. Sanus company's total comprehensive income for the year, okay, ended 2004 was 2 million. What does this mean? This mean, so this is the balance sheet, right? 10,600 is the total reserve. Come on, tell me yes or no.
Yes, sir.
In this, they are saying that after the acquisition, Sanus company total comprehensive income for the year ended was this. So after acquiring this company, the reserves which came out to be is 2000, right? So if I remove 2000 from this total reserves, which is nothing but the post acquisition reserve, okay, what is the difference?
8,600.
8,600, right? But this 2000 also has got created not for the entire year, right? This we will be checking out. Accruing evenly over the year. So S company total comprehensive income for the year ended, this was 2.0, accruing evenly through the year. That means this 2 million, accordingly, evenly is nothing but after acquisition only it has come, right? This is not the total amount from the beginning. Is this the total amount from the beginning?
No, sir.
This is after the acquisition has happened, right? So we will take that 2000 and we will do that part into 9 by 12. How much is that? You tell me.
1,500.
So this amounts to 1500. So 10,600 minus 1500 is how much?
9,100.
What is that now? 9,100 for you.
Goodwill.
What goodwill? This is pre-acquisition reserves, right?
Okay, okay.
Yeah.
So this
So
will be considered not goodwill, sir.
this is not goodwill. This is pre-acquisition reserves. This will be considered for the calculation of goodwill. Are you understanding?
Yes, yes, sir.
Yeah. Now we will do the calculation of goodwill. Okay, so this was the only point I wanted to calculate because this is a part acquisition, not full acquisition. So what is the consideration transferred? So we were doing that, right? So we will do this calculation here only. Consideration transferred was 13,800, right? What was the NCI? The NCI at fair value is how much? 3.2,
3.2.
correct?
Yes, sir.
I will add that NCI 3,200. Okay, consideration transferred NCI less equity net assets represented by equity. So we will take the equity share capital. What is the equity share capital in this book, in this question?
13,000.
13,000. Share capital of subsidiary is how much? 20, somewhere around 2,400, right?
Yeah, 24.
24. Yeah. So we will take that 2,400 share capital. We will take the pre-acquisition reserves. What is that we calculated right now?
1,000.
9,100, right?
Yes.
Now you completely
We should
do this
add
and
it
tell me that.
pre-acquisition.
Just a second, Isha, just a second. Yeah. So Isha, did you calculate this?
So should we add that pre-acquisition or minus it?
Pre-acquisition, you need to subtract all this, right?
No, so we should add that NCI part, na? NCI we should add
NCI
minus.
NCI part you have to add. That is known fact. Then you
Yeah.
have to remove everything.
Okay, we should even remove this pre-acquisition.
Yeah.
Okay, then it's 5,500.
Yeah. This is your goodwill part, right? Okay. Calculate this. I'll just get some water. Do the calculation. and also add the amounts, consolidated amounts. You have the balance sheet figures, right?
No, sir.
And yeah, these are the figures. Do the calculation as well. Yeah. So just you can add this 56,600, 16,200, right? Hello.
Yes, sir, doing.
Yeah. Add
It's
them and tell me the
72,000.
value. Yeah, I will write those values there directly. 72,000.
800.
What is the PP? Goodwill is
Uh,
5,500 calculated.
78,300.
Yeah. Inventory.
4,100.
Okay. This already we have calculated, right? 4,400. Cash was 1,800, right?
1,800. Yes, sir.
Then what about the share capital? Only parent share capital should be taken, right?
Yes.
Then what about the reserves? What about the reserves? So you do this, I will be calculating the reserves and NCI, and we will be finishing this. Shall we do the calculation of reserves?
Yes, sir.
Reserves. So the parents' reserves were 54,100, right? And 10,600 was the total reserves. We will remove the pre-acquisition reserves. We will remove. So post-acquisition reserves are how much? 1,500, right?
So once again, sir. Can you repeat, sir?
See, this was the reserves given to in the balance sheet date at the end of the year. This is pre-acquisition reserve, right?
Yes, sir.
So what is the post-acquisition reserve? 1,500, correct?
Huh.
What matters is the post-acquisition reserve, not the pre-acquisition reserve, right? That has gone for the goodwill calculation. This pre-acquisition reserve has gone for the goodwill calculation. What is the post-acquisition reserve?
Huh.
1,500. Out of that,
Yes, sir.
80% goes to parent. Parent are right here. So 80% of this is how much?
1,200.
1,200. Just add this. 55,300. And what was the NCI fair value? 3,200, right? Rest of the
Yes.
300 will be given to NCI. That will be 3,500. Is it right?
सर एक्चुअली आपके स्क्रीन में कुछ दिख नहीं रहा सर, आप जो लिख रहे हो, तो मुझे फिगर समझ नहीं आ रहा।
How come? Just a second. I'm sharing once again. Can you see now?
नो सर।
In, not still even. Just give me 2 minutes. I'm calling once again.